Here we are within the area of risk management and will now take a deep dive into credit risk management. Components of credit risk. There is two components of credit risks. Credit risk or counterparty default risk arise as soon as contracts for energy supply or consumption are concluded. You always have a counterparty, and that counterparty always, at least hypothetically, may go into insolvency. They may go bankrupt. It's extremely unlikely for exchanges due to the regulation in place, but even for exchanges, which is probably the safest bet you can take, it's still not zero. So whenever you agree and sign a contract, credit risk may occur. However, of course, it only happens from your perspective when the counterparty is owing you. As long as you owe the counterparty, your credit risk is zero. It can never become negative because, as I said, if you owe the counterparty, even if it goes bankrupt, you still have to deliver. Because, as I explained before, the other debtors of the company have to be fulfilled as far as possible. So the person in charge of the insolvency, typically some external lawyer, will then approach and try to monetize all potential sources for money. And then he will stumble upon the contract where you owe that bankrupt company money, and he will come to you and say, look, you owe our company money. I know you're bankrupt, but please still pay, and you have to pay. You don't have any legal basis to say, well, you're bankrupt, I won't pay you. So credit risk only refers to if the other party owes you money, so it can be either positive or zero, but in a way it can never become negative, so you can never profit from an insolvency of your counterparty. That's one important upfront issue. Second, credit risk is made up of two components. Resale risk or rebuy risk, which is the difference between market price and contracted price of undelivered energy quantities. So for example, typically you sold something to somebody for 55 euros, for example, electricity contracts per megawatt hour. In the meantime, the price dropped to 50, and you say, well, I'm very happy about that deal. I sold when the price was still high for 55. If I had to resell it, I would only get 50 in the market, because all the other market participants will tell you, well, it's quite nice that you sold it at one point for 55, but we are not interested in this in the past. Look at the market price, look on the screen. It's 50 right now, and that's what we're going to pay you. And of course, you have to acknowledge that's what it is. If the market price is 50, well, nobody's going to pay you 55. So this is the resale risk. It may, of course, also be a rebuy risk. You bought cheap from somebody 1 or 2 years ago. In the meanwhile, prices went up. So you again say, well, I'm very happy I bought so cheap. But now if that person, that counterparty fails, goes bankrupt, does not deliver, you have to rebuy, and now you have to pay a higher price. Again, that may or may not manifest if you bought, but the price went down. You would be interested in not honoring your contract, rebuying cheaper, but again, you have to fulfill. Again, it's zero at best, the credit risk. Okay, so that's the resale or rebuy risk, one component. The difference between market price and contracted price of undelivered energy quantities. And the second component here specified as free delivery exposure. This is the value of already delivered but still unpaid energy quantities. So you start at some point to deliver, and then typically payments happen later. We will, on some of the next slides, look at the severe importance of this. The typical contract specifies, if you hear it about this for the first time, probably surprisingly late payment dates. So free delivery exposure, again to repeat, is the value of delivered but still unpaid energy. And the total credit risk or credit exposure is the sum of both components. That is, credit exposure is equal to resale rebuy risk plus free delivery exposure. I already promised the surprisingly late payment dates. Here we have a screenshot from an EFET payment contract. EFET stands for European Federation of Energy Traders. They started when Europe liberalized the energy markets to set up market guidelines and rules. And they offered some standard contracts, EFET standard contracts. And there, if two parties wanted to agree on buying or selling energy, they could look up the EFET standard contract and then slightly adapt that, but generally take it, because it was kind of a neutral thing. So it saved both parties work if they took the standard contract, and at the same time it was not one party coming up with a suggestion and the other party saying, I don't really know whether I like your contract specifications so much. Because the person writing the contract is probably not writing things in the contract which are very bad for them. So you had to check every line of the contract. But if a neutral third party suggested here, if you want to trade electricity, use this contract draft, then it was much easier to agree on the framework. But let's look at this draft, which used to be fairly established. It's specified in paragraph 12, invoicing and payment. The invoice is sent, and here we have underlined it in red, in the course of the calendar month following the delivery. So in the month after delivery, you send the invoice. And paragraph 2, or actually the second paragraph, specifies payment on or before the later to occur of the 20th of a calendar day of the month following delivery. So typically this is the binding constraint if you send the bill soon enough. But this means here energy delivered during any given month is paid, the payment is due on the 20th of the month after delivery. And this is where the free delivery exposure is coming from. So you, for example, deliver all of January, you don't see any payment during January if you stick to this EFET payment conditions. You start February, maybe you continue to deliver in February, and then on the 20th of February you get paid, but you get paid only for the energy delivered in January. So this is very realistic. Let's look at the credit risk with an example. Here on this slide you see the credit risk of a base contract of 50 megawatts, sold for 55 euros per megawatt hour for the delivery period of January 1st until 30th of April of any given year. So for 4 months, January, February, March, April, 4 months delivery at a market price of 50 euros per megawatt hour. So now during delivery, the average market price is assumed in this example to be 50 euros per megawatt hour. And now assume the credit risk directly before the first payment is made on the 20th of February. What's the credit risk of this situation on the 20th of February before the first payment arrives? You also have a graph in the middle of the slide, which starts with contract signature. Assume it was on the 10th of October, the year before delivery, and we agreed to sell these 4 months 50 megawatt as base load. So every hour of the 4 months from January to April, you agreed to deliver 50 megawatts, and your counterparty agreed to take the energy and pay you 55 euros per megawatt hour. That happened on the 10th of October on the year before delivery in this example. Then for a few months, October, November, December, nothing happens. Then 1st of January, starting with the green here, specified in the green bar, we start delivery. So you deliver energy. But as we said, during the first month of delivery, nothing is paid. The first payment is due on the 20th of February. Market price, as we said in this example, 50 euro, you see in the middle of the graph. And then you continue to deliver. You can go through this time scale. Delivery ends 30th of April, but the last payment arrives 20th of May. What's paid in 20th of May? Please think about it for a moment. The month of April. April is paid 1 month later on the 20th of May. Okay, so what's the credit risk on the 20th of February? One is the resale risk. So on the 20th of February, if our counterparty breaks down and does not take the energy, we have to resell it somewhere else. We can only resell at 50 instead of at 55. We will sell the undelivered energy, so everything that was supposed to be delivered from the 20th of February until the 30th of April. And that is 30 days in April, 31 days in May, and 8 days, remaining days in February. So in total, 69 days. That's what you see here, beginning of the resale risk formula. 69 days of undelivered energy of 50 megawatts. So you multiply 69 days by 50 megawatts by 24 hours per day, because these 50 megawatts are delivered in each hour of the day or constantly. So it's times 24 hours per day to get megawatt hours, and then times 5 euros per megawatt hour. The difference between the 55 you agreed upon in the contract and the 50 you can currently get in the market. 55 minus 50 is 5. So that's the resale risk. And I think I mentioned this in a previous video. If, for example, hypothetically, you are in this situation for real, or if hypothetically you want to pass an exam on it, I give a hint. Please check the units. The units greatly help whether you did the right thing. And here we multiply in the units days by megawatts by hours per day, meaning the days cancel each other out. We have them above and below the fraction. We have megawatts above and hours above, so we have megawatt hours, which we then multiply with 5 euros per megawatt hour. So then the megawatt hours cancel each other out, and then just euros remain, which is a good sign, because if you want to quantify a risk, you typically have euros. Very rarely, occasionally, you may also have euros per megawatt hour, but typically you express risk simply in euros. And that is the unit we end up with here. So this is good news. And of course, it's correctly calculated. And that is a resale risk of, in this example, 414,000 euros. Of course, if, for example, it would have been a base contract for the full year, for the whole year, that would have been significantly higher. But here, still, even in that medium-sized contract, 440,000 euros. And then the free delivery exposure is the second component of the sum. That's what we already delivered, but did not get paid for yet. What did we deliver? We delivered all of January, 31 days. We delivered until the 20th of February, so 20 days in February. That's a total of 51 days. We delivered 50 megawatts. We delivered these 24 hours a day. And they owe us 55 euros per megawatt hour. So we multiply all this, and that's 3,366,000 euros free delivery exposure. And then, as we said, total credit risk, credit exposure is the sum of the two components. 414,000 plus 3,366,000 is in total 3,780,000 euros. That's the corresponding damage in the event of bankruptcy, insolvency of the trading partner. Of course, this is the worst case here. This trading partner really defaulted on the point in time it owed you the most money. 20th February was worst from the perspective of this contract. But still, even if it would have happened on the 20th of March or something, it may still be pretty bad. Furthermore, of course, it is not uncommon that bankruptcies get known when a major payment is due. Because your counterparty may try to save the company. They, of course, hopefully are all working very hard to try to find a solution to their financial struggles. Maybe find another big deal, maybe find another bank loan whatsoever. And then at some point, there is some bill which needs to be paid. And then they say, well, honestly, we can't do it. And then they say, okay, we have to admit we are bankrupt. That's not how it should work, of course. You should be more proactive on this, and you may even run into legal trouble if you wait too long declaring bankruptcy. But still, that may be what happens. So it's not completely unlikely that you may have such a high credit risk. Furthermore, whether you immediately stop delivery once the bill is not paid is also questionable. Imagine the following scenario: on the 20th of February, they don't pay. First thing you realize, maybe you're pretty quick, you realize immediately. And then you may be willing to call them and ask, hey, what's happening? You're not paying your bill. You owe us money. And then, regarding of circumstances, if you're truly unlucky and they're somewhat even with at least one foot on the other side of the law, they may tell you, yes, we are working on it, you will get it. And then you probably continue to deliver if, for example, you have an established standing relationship with that client. And then you may set them a limit of a few more days. Or you may not even call immediately, but just send an email. Here, look what happened. You haven't paid your bill on the 20th of February. Please pay by the end of the month, or something like this. So point is, you may not stop delivering immediately, even if the bill was due. And then you, in a way, continue to deliver. So in a way, you throw good money after the bad money. Because, of course, this is not likely to get paid either. On the other hand, it has to be said that this may be a worst-case scenario in a way, because quite often if a company is bankrupt, it doesn't imply it's not paying a single euro. As I said, the lawyer typically responsible for the insolvent company will try to get as many revenues as possible and tries to pay debtors as many debt as possible. So if you have 3,780,000 euros of credit risk and they go bankrupt, doesn't mean you don't get a single euro. You may get at least some money. But still, you see the order of magnitude, you see the importance of properly manage credit risk. This graph sums it up, what happens in this particular case. Here you have free delivery exposure, rebuy risk, resale risk on the vertical axis. Again, the graph on the horizontal axis starts 10th of October, conclusion of contract. And then directly, immediately what happens, rebuy resale risk may happen due to fluctuations in the forward future price. As I said, it's limited at 0, it cannot go into the negative. Best case or rebuy resale risk in that regard is 0. Or it can be, as happened here, prices declined, you sold at 55. The lower prices are, the more rebuy resale risk you have, and you see that in the red line, it's going up. And here it's very high at the start of delivery. The red is very high because if they would default on the 1st of January, your rebuy resale risk would be the full 4 months, which you would have to sell alternatively. So instead of just multiplying, I think it was 69 days remaining by February 20th, you would now have roughly 4 times 30, 120 days. So 4 months, somewhat approximating 30 days per month, you would have 120 days. You would have to resell at 50 instead of getting your 55. So this rebuy resale risk then depends, still is influenced by the price development, but once you have reached the end of delivery, the rebuy resale risk is 0, of course. Okay, but with the start of delivery, something else happens, the free delivery exposure in blue. And that goes up, you see here. And it gets maximal before the first payment, in this example on the 20th of February. And then on the 20th of February, in the blue line, you get a payment, it goes down vertically. You receive payment and free delivery exposure is reduced by that payment, exactly. Why does it not go down to 0 here? Because what gets paid on the 20th of February, think about it, and then what remains open, the 20 days of February. Okay, so then again, the free delivery exposure continues to grow after you received that payment on the 20th of February until the 20th of March, where again, your counterparty owes you all of February. January is paid, but they owe you the full February and they owe you 20 days of March. And then you get paid for February and it goes down. And then again, we have the same issue. And then we have the last month where credit risk or free delivery exposure starts to grow in April, but then it stops to grow by the end of delivery, in this example on the 30th of April. Why? Because their delivery ends, but you don't get payment immediately. You don't deliver any additional energy in May, but you have to wait until May 20th before you get finally paid. And then, if everything went well, on the 20th of May, your risk, your credit risk, finally is 0. So that's, again, a visualization of this example. I think it's very helpful to understand what's going on. Then the factors influencing credit risk. The credit risk increases with the contract's quantity. So the higher the contract volume, the more you agree to buy or sell, the higher the credit risk. Terawatt hour is different from 10 megawatt hours. The credit risk also increases with the time duration between the conclusion of the contract and the start of the delivery period. Of course, if, for example, you agree now on a delivery in, I don't know, 10 years from now, quite a lot can happen in the next 10 years and the prices can fluctuate very, very strongly. So the position can get very, very valuable. While if you agree to deliver something next month, then the price change and the potential for price changes is much more moderate. So to repeat, the credit risk increases with the time duration between the conclusion of the contract and the start of the delivery period. Furthermore, the credit risk increases with the price increase after purchase or the price decrease after a sale. So whenever it goes generally in a favorable direction for you, your counterparty owes you money. That's what happens. The contract becomes valuable for you. And that, of course, is directly mirrored one-to-one in the credit risk. The credit risk increases with the number of opposing positions without netting agreements. This is just to repeat. I specifically discussed netting agreements. If you don't remember, please stop, go back to the description of netting agreements. And last but not least, the credit risk increases with a lower credit worthiness of the contractual partner, of the counterparty. So if the counterparty has a low credit worthiness, then they are more likely to go bankrupt and then they are more likely to not pay their bills. And of course, there is a certain difference here. For example, if you have a government-controlled municipality, it's probably less likely that they default compared to a privately owned hedge fund energy trading company. And thus, it is necessary to limit the credit risks depending on the credit worthiness of the contractual partners. So you should differentiate how much money the counterparty is allowed to owe you depending on how trustworthy, how creditworthy you find them. And you may well make a difference between a small niche boutique trading company you have not even heard of before, they approached you to trade, and a very solvent, large player in the field, like an electricity major or even an oil major. Of course, you have to see this in perspective. I'm not saying oil majors will be able to pay their bills from now on until eternity. But if, for example, the company made 10 billion euros profit last year, it is pretty likely that they will be able to pay their bills this year. It's not a guarantee, mind you, but it seems more likely than, as I said, using the example of a niche trading company where like 3 students started trading in the garage, setting up a fast computer and trying to leverage millions of euros. It's a nice thing I would personally favorably accompany, but the credit risk is obviously there. Okay, so if you have to assess the credit worthiness and the trustworthiness of your counterparties, how do you do this? This is typically done via credit ratings. How can you come up with the credit rating of your counterparties? Here is an overview. There is 3 main ways. The first is on the left, quantitative analysis, for example, from balance sheets. You look at your counterparty's capital structure, you look at their liquidity, you look at their profitability. I just mentioned that as an intuitive sign of solvency. If they're very profitable for the last 10 years, it's quite likely they will be able to pay their bills this year. Business development, you can look at all the information you have available, and typically companies even have 1 or 2 in-house experts looking at that. And then they come up with possibly preliminary credit ratings of the contractual partner. based on this analysis. So that's one way. Second, in the middle, you can use results from external rating agencies. There is companies specializing on providing this much needed information. How trustworthy, what's the credit rating, what's the default risk of a counterparty is. For example, Standard & Poor's, Moody's, Fitch are specializing on providing quantitative estimates of default risks. How likely is it during the next year you won't see your money? So that's of course another way. Then you kind of do not have yourself the full control. You have to trust the external experts. But of course it makes a certain sense if that is done for a huge trading company like say RWE just once, and then people can just look at that rating instead of hundreds of trading partners of RWE are all assessing themselves the risk associated with trading with RWE. Okay, and then last, and in this time probably least, is qualitative analysis. You only do that if you don't have quantitative information. Qualitative analysis is still valuable, but probably inferior to sound quantitative analysis. Here, we face the case where you don't have information. You don't have or can't afford results from external rating agencies such as Standard & Poor's. So here, you try to do what's left in a way, and you try to look at the company type, the legal form, whether it's stock exchange listed, how the sector develops. You don't really know about the company, but if everybody in that sector made a fortune last year, you just hope that this company is not the only exception. Things like that. And again, you can use all these informations to come up with a possibly preliminary credit rating of the contractual partner. Sometimes you may have to assess the credit rating of a parent company. For example, there was an oil major who was very solvent, earning billions of euros every year at the time, but he set up kind of a very small niche trading company as its own company. It was called trading or energy trading, but it was a different legal entity from the oil major, which was called And the question for trading was, will the parent company cover for their trading company? Legally, they did not have to. But of course, there would have been an image problem if trading would have gone into bankruptcy and would have said, no, we're not paying. It's not our company. It's kind of, well, it is our company. We own it, but we are not responsible for their loans. So we just let our company go into bankruptcy. We, as a shareholder, say, well, our shares in the company are now void and worthless. That's our risk. But we are not paying the loans and problems this company had. So there was the question, do you say, well, the parent company is very solvent, we believe they will cover the bills, or did you just look at this rather smallish, risky company they set up for trading? Okay, and you may possibly look at the credit rating of the parent company here. Okay, but then at some point you have to, based on all the available information, make up your mind and determine credit rating of the contractual partner you believe in to the best of your abilities. And then based on that credit rating, for example, Moody's, Standard & Poor's, and these companies, they have different letters. AAA ratings you may have heard, or the best rating you can get for some of these. And then, so that's the credit rating. And then there is one missing step. The last step is you have to determine a credit limit of the contractual partner. That is how much trading activity you allow based on that credit rating with that company. You may say if the credit rating is bad, we don't allow our traders to engage in trades. Can be done, fine. Shouldn't happen too often, because then in the end, if you don't trade with anybody, you can't trade. And then you can say, look, if it's very, very high rated, very good credit rating, AAA credit rating, then it's very unlikely that they go bust. And then you say, then we allow 10 million outstanding debt, for example. We allow credit risks to amass to 10 million. And once that is reached, we have to take certain preventive measures, for example, not engage in any future trades with them. So that is the process of deriving credit ratings for contractual partners, and how in the end you limit the credit you give to these contractual partners on that basis. Okay, this slide here is meant as a reminder to myself. Standard & Poor's default probabilities. Please check Standard & Poor's homepage and assess the default probabilities they give to certain companies, or what their rating means in terms of default probability. You could also use other companies, but Standard & Poor's is one example. I don't have any affiliation with them, but they had pretty transparent information on their website. So please look that up. How does Standard & Poor's rate companies? And what does the rating, what different ratings are there? And how do they translate into default probabilities? And of course, these default probabilities, all these statements are forward-looking. If you have an expert within your company, that person does not know when, which, if a company will go bankrupt. Obviously, you can't know that in advance. You can just, to the best of your ability, estimate the likelihood for the event. And here, please go on their webpage and make yourself familiar with that. Then we move on with the limit the credit risk implies with the help of a limit system. Here is an example from a company. We have 8 different credit ratings in the left column. We have the associated counterparty default risk. We have a credit rating number, which in this example goes from +6, which is best, down to -6, which is worst. And then on the very right column, we have an exemplary credit limit we allow our traders to amass with any of the different companies, depending on in which credit rating class they are or which credit rating number they have. So if we look at the first line, credit rating 1, extremely high credit rating, counterparty default risk is almost 0. Credit rating number associated to this in our quantitative system is between 4.5 and 6. And then if that happens, so we find the counterparty default risk is almost 0, then we allow a high credit limit of 50 million euros. If the credit rating is too very high, the counterparty default risk is very low, credit rating number is between 4.5 and 3.5, and we still allow a credit limit of 30 million. And then it goes down, the worse the credit rating gets. And you see here that with low, you're just allowed to have a credit limit of 250,000 euros, and with 7 and 8, very low and extremely low, so counterparty default risk is high and very high, you are not allowed to trade at all. You don't want to trade with companies with such a high default risk. Thanks for watching this video.